last but not least, it's called New Market-Based Evidence. I'm going to turn it over now to Geeta Rao, who's going to be the chair for that session.
Thank you, Debbie. It's my pleasure to be here with our participants. This is in this New Market Evidence panel. I think it's going to be really interesting, and we invite your questions afterwards. Let me just start by introducing our first speaker, who is Lakshmi Narayanan from the London Business School. And his paper is co-authored with Kunal Sachdeva and Varun Sharma. So over to you, Lakshmi.
Thank you so much, Geeta. Thank you so much, Debbie. Let me just share my screen. I hope all of you can see my screen. Okay, fantastic. So thank you so much, Debbie, Geeta, and Marcin for kind of putting together the conference and also kind of spending time on reading the paper. This is joint work with Kunal at Rice, as Geeta mentioned, and also Varun Sharma, who is a PhD candidate at LBS, and he'll be on the academic job market this year. So please have a look at his package, once you get it. So I guess all of us can agree that perhaps climate change is the greatest risk for, that humanity is facing in the foreseeable future. And by now there is mounting evidence, both academic and otherwise, that these climate change risks can pose significant threat to firm profits, households, and investors alike. And against this backdrop, increasingly long-term institutional investors such as pension funds are concerned about the viability of their portfolio firms in the context of climate change risk, and have been increasingly pushing forward, boards and managers in general to address climate change risk adequately. And much of this is kind of being done, either through engagements, activism, or through their voting patterns, or a combination of all these three. And in this paper, we are going to kind of think about, what happens, when investors start engaging with boards of firms with the precise understanding and requiring them to make changes along their corporate environmental behaviors. Right. So our focus is going to be environmental activism, and by which we're going to understand that shareholders are going to engage with the boards to improve their corporate environmental behavior. And this differs from your traditional investor activism, such as hedge fund activism, etc., that aims to improve the financial and operational performance of the firm. At the same time, there's also a bit of academic literature which talks about divestment campaigns as an alternative to such activism episodes. And increasingly, they find that these divestment campaigns come at lower future expected returns. But between these two kind of broad academic literatures, there is, if any, understanding of the ability and willingness of long-term shareholders, such as pension funds, to affect change, and if so, if there are any externalities, and conditional on firms making these changes, how are they going to respond? And the focus of this paper is going to kind of shed light on this question of, does environmental have any real effects, and what are the firms doing in response to such activism episodes? Right. So to give you a brief preview of the results, we're going to use an episode in the United States of environmental activism by a big big pension fund system. And we're going to look at 4 different things. So the first thing we're going to show is that around these environmental activism campaigns, you find that firms respond positively by altering their pollutive activities. So they reduce their toxic chemical releases, stack air emissions, and greenhouse gases. Second, we're going to show you that conditional on these changes, we find that these changes generate positive externalities on the local economy. And here we're able to measure these positive externalities at a very local granular level using air quality monitor data and a couple of other data sets, and I'll talk a bit more about them. The third thing is, we shed light on what firms are doing and how are they achieving these changes. And here we find that firms undertake a combination of short-term operational improvements and long-term investments in abatement technologies. And we're going to find that that's how firms are making these changes. And lastly, we want to understand what are the costs and benefits in terms of whether sustainability performance comes at the expense of financial performance. And we do find some suggestive evidence that improvements in sustainability performance do come at the expense of financial performance, especially lower operational efficiency and profitability. However, we are careful in interpreting these results because maybe the benefits may accrue in the long term, and because we're using balance sheet data, some of which might be backward looking, we can't quantify all the benefits at this point in time. Right? Overall, we take to believe that these 4 pieces of evidence put together suggest that perhaps investors can delegate their pro-social preferences onto firm. Now, let me kind of quickly walk you through some of the specific details on how we kind of pin down some of the analysis. So essentially, we're going to rely on this boardroom accountability project, which was a campaign that was kicked off by the New York City Pension Fund System in 2014. And through the system, the comptroller, Mr. Scott Stringer, started filing proxy access shareholder proposal, which gave share owners who held a certain fraction of the firm ability or a choice in the election of directors responsible. And they chose few mandates for targeting particular firms, of which climate change was the most important mandate. So if you kind of look at what Mr. Stringer said at the start of the campaign, he kind of emphasized this, that especially when it comes to the environment, business as usual is no longer an option. And once this campaign was launched, they quickly kind of formed a coalition with CalPERS, CalSTRS, and other big investors. And together they attended, coordinated their meetings, they attended and communicated to other shareholders and management of their dissatisfaction from different firms on their ability to or lack thereof of addressing climate change risk adequately. And they communicated this across the board. And we're going to kind of show you that this coordination and this coalition kind of led to some of the changes that we document in the paper. So in terms of the empirical analysis, we rely on a typical difference in differences analysis, where for every targeted firm that the comptroller chose for lacking or addressing climate changes adequately, we find a counterfactual firm which is in the same industry and which looks similar along financial characteristics and non-financial characteristics or sustainability characteristics. And here we have the ability to directly kind of speak with the investor and understand better what the targeting criteria was, and also understand what was the universe that they were looking at. And we use that information and also validate at great lengths in the paper that it was indeed the case that the counterfactual set of firms belong to Russell 3000, and we kind of narrow it down. And we do a lot of robustness in the paper, given the importance of this matching methodology, to show that it's robust to using different type of financial variables, sustainability characteristics, level trends, and so on and so forth. So we're going to compare throughout the paper a plant of a firm that was targeted relative to another plant of a firm that was not targeted but was in the same industry and looked very similar along both financial characteristics and sustainability characteristics. And in this paper, I think one of the things that we do is we put together a massive amount of data set triangle that allows us to not only sidestep some of the issues that come with using just one kind of rating specifically, but also allows us to triangulate whether what we are finding is consistent across different data sources and is not driven by any biases of using one particular data set in general. So here, as I walk through the results, I'll kind of explain some of these data sets that we. So just in case I ran out of time, I just want to emphasize that if there's one thing that you want to take away or one result, it's going to be this. So what we do here is we look at how does the pollutive activity evolve for plants of targeted firms relative to plants of control firms around the activism campaign. And here you can note, three particular things. One is, before the campaign, you don't find there is any differential differential level of polluting activity. Second, you can see that right after the targeting campaign, you see there is a decline in the pollutive activity of targeted firms relative to control firms. And the third thing is that this is persistent in the 3 years out of the targeting event, right? And we're going to show you that this persistence comes partly from the fact that some firms decide, or rather some plans of targeted firms decide to make short-run operational changes, while some decide to invest, make changes both in the short run and in the long run in the form of abatement technologies. If you kind of control, so that was just simple graphical representation. If you kind of control for fixed effects and everything, you find that these results go through. Effectively, if you want to interpret these estimates, what we find is there is a reduction of 13% relative to the sample mean in terms of toxic chemical releases of plants of targeted firms relative to plants of control firms. We can also kind of look at whether these reductions are coming from gases that affect global warming. And here we are able to observe through the greenhouse gas reporting program of the EPA what each of the plants how much they're emitting CO2 into the atmosphere. So here we can break down even further, not just CO2, but also nitrous oxide and methane. And what we find is around the targeting, there is a significant reduction in greenhouse gas emissions. So kind of summarizing what I've shown you up until now is around the activism campaign, there was a significant reduction in greenhouse gas emissions and toxic chemical releases. The next question is there a measurable impact at the local economy? And here what we do is we rely on the integrated risk information system from the EPA. And this database provides that each chemical can affect a different bodily function. And we can map this to the chemicals that the plants release around the activism campaign. And we can think about whether firms are strategically or actively changing what they are releasing into the atmosphere or releasing into different sources of medium. And what we find here is, as some chemicals are more harmful than others, we find that firms or plants of the firms that were targeted are strategically, changing or reducing more harmful chemicals in their production processes relative to less harmful. So if you kind of look at this table, you see that those chemicals that affect the respiratory systems, development systems, and hematologic systems, firms are actively reducing the chemical releases of these particular chemicals as opposed to less harmful chemicals. So there is a positive impact by this metric. The second thing we do is we look at a 1 mile radius around the plants of targeted firms and look at what happens to the air quality. As I showed you before, there was a significant reduction in greenhouse gas emissions and stack air emissions. And here we just are trying to quantify if we see a measurable impact around a 1 mile radius of plants. And when we use this data, we again find that there is a reduction in key criteria gases as observed from the air quality monitoring data. We also substantiate this using satellite data and find that even with satellite data, you find similar results in terms of particulate matter and so on and so forth. So this is the second way in which we measure positive externality to the local economy around the plants of targeted firms. The next thing is, so far last time I showed you was just that there was a reduction in chemical release, but I did not take into account, how much it's going to affect the local population. And here we use another metric, a modeled estimate from the EPA called the risk screening environmental indicator, to take into account the fact that how toxic each of the chemical releases and conditional on it being released into the atmosphere or into different medium, how likely is it to affect a particular percentage of the population. And here, if you kind of look at this map, green dots are showing you changes in the RSEI indicators, whereas red dots are showing you, worsening of the indicator. What we find is after targeting, there's a substantial increase across geographical location and not just close to the New York City pension fund system. You see that there's a widespread local change in polluting activity as measured by this model estimate. So this suggests that perhaps having this activism episodes can have an important externality for investors who are also located far away from the investor base. So in this case, the investor base was concentrated in New York City, but here you can see that you find significant improvements at distant locations in general. The third obvious question is that how are firms achieving these? And here we are able to measure, as I talked about before, both short-run and long-run improvements. So in terms of short-run improvements, we can look into what specific measure plans are taking, those that were targeted by the comptroller are taking specifically. And here we find that improvements do come from operational efficiency, such as instituting good operating practices and installing fire alarms for spill and leakage prevention. So these are some of the short-term investments that they're making. And the second thing is, we also find evidence that, some of the plans of the firms are also investing in capital expenditure in the long term. So here here we have total expenditure on abatement versus how much of it is being spent on maintenance and operation. And here you can see that, some plans of firms are in fact investing in long-term abatement technology as opposed to just investing in maintenance and operation. So put together, these two pieces of evidence suggest that, firms are actively responding by changing short-run, making short-run improvements and long-term abatement investments. Lastly, one might be, yes,
Lakshmi, we have 3 minutes more.
Oh, absolutely. Thank you so much. And lastly, you might be wondering that, maybe, some of the effects that I've shown you might be driven by changes to production as opposed to, activism playing a role, right? So the concern is the fact that, maybe, the firms or plants are producing less, and by virtue of producing less, they're also polluting less. Right. So if instead that's the case, then it's not the activism that is leading firms to make these changes, but however, changes to production. So here we don't have exact data on production, but we can compute a production ratio and normalized production ratio at the plant chemical level using the EPA data, and we don't find any evidence of changes or reduction in productions. If anything, what we find as if you kind of consider results from before, is that firms are actively making these changes both in the short run and long run and responding to the activism campaign. Of course, the obvious question is that, these improvements in sustainability performance, do they come at the expense of financial performance? And here, what we do is we take balance sheet and income statement information on profitability and, distress risk and so on. And what we find is there is a significant decrease in the financial performance of targeted firms. However, we caveat this by saying that, benefits, as has been documented in the literature, can take a longer time to materialize, and perhaps some of these effects cannot be quantified immediately around the targeting episode in particular, and maybe we are missing out on some of these effects. So one has to kind of take these results with a grain of salt. We also spend quite a bit of time in the paper showing that these results are not specific just to the BAP campaign, the size and influence, but also hold for other campaigns that were similar in nature. And we spend quite a bit of time in the paper making sure that our results are robust to the methodology we use in terms of propensity score, making sure that it's not driven by offshoring, it's not driven by looking at only smaller plants, it's not driven by any selection bias and so on and so forth. And also we spend quite a bit of time to show that the results are coming from the fact that the BAP campaign was specific in its demand. So when we look at a sample where they were targeted for diversity, we don't find them to improve their their pollutive activities in general. So let me
Lakshmi, I think time's up, if you don't mind.
Yeah, no worries. So let me just conclude by saying that what we think in the paper is engagement is, going forward, going to be an important tool to address climate change risk. And I think we've taken a first step in kind of documenting that. Thank you so much for your time.
Thank you. And I really appreciate you doing this and staying on time. Our next speaker is Maria Jacinta Giannetti from the Stockholm School of Economics, CEPR, the Swedish House of Finance, and ECGI. This paper on fund manager incentives and sustainability ratings is co-authored with Nikolay Ganchev and Rachel Lee. So take it away, Maria Jacinta.
So thank you for having me, and especially thank you, Debbie, for inviting me. So In this paper, so we have been hearing a lot about the role of that transparency can potentially have to make investment more sustainable and to give incentives to firms. But a lot of these presume that investors solve the trade-off between transparency and performance in favor between sustainability and performance in favor of sustainability. And we have very little evidence about this. There is, and we saw it also from Roberto's presentation, there is a lot of confusing evidence on the fact that sustainability should have own performance. And what I am showing here is some recent articles that are more from the Financial Times, from a report from NYU Stern, and so on. So what we try to, our ambition in this paper is to show how greater transparency affect the allocation of capital once the trade-off between sustainability and performance becomes salient. So we look at a corner of the asset management industry in which investors are don't have explicit ES preferences. So these are just mutual fund investors. Specifically, what we do is looking at the introduction of Morningstar Global Ratings. These global ratings rank funds within their categories based on the sustainability of their portfolio, and are expected to be a clear matrix, and upon introduction have been shown to affect flows. So what we want to know basically is to what extent they affect the mutual fund investment, and in the long term how much they affect fund flows. So let me be a bit specific on what these ratings are. They range from 1, the worst, to 5, the best. They have been introduced in March 2016, and these are just a ranking of the funds within a Morningstar categories on the basis of the sustainability of the fund portfolios. So Morningstar also has other ratings that rank the funds on performance. These ratings have been shown to have a larger impact on the flows to the mutual funds portfolio, and they also rank mutual fund investors based on their past performance. Based on their past performance. So a top star rating means that a mutual fund has been performing much better than the peer. So let me tell you in a nutshell what we are going to find in this paper. We confirm that immediately after the introduction of the sustainability ratings, funds received relatively more flows. And this led asset managers to change their policies. We show that asset managers that were close to improve their ratings, try to invest to a larger extent in sustainable stocks to achieve a better rating and achieve more flows. However, the higher demand has an effect on stock prices. So what we show that the prices of stocks with high sustainability ratings increase, and these stocks become overvalued. So in the month, the following the high demand created by the globe chasing investors, we find that these stocks have worse performance. So what does that mean? Well, this means that other funds that aim to achieve better performance to attract flows can trade against the investors pursuing better global ratings. And we find that this is the case, especially fund managers that were close to improve their star ratings attempt to sell the stocks that are becoming overvalued and buy the stocks with poor sustainability ratings that are becoming undervalued. So this creates a clear trade-off between sustainability and performance. So in the 9 months that follow the introduction of the sustainability ratings, we find that funds that improve their global ratings are actually downgraded with respect to their star ratings. That is, those performance ratings that have been shown to have a larger effect on flows. We also find that the controlling for factors that are known to be associated to mutual fund performance, that the funds that purchase stocks with high sustainability ratings more than the average experience lower alpha. So this is the clear trade-off between sustainability and performance that emerge. So after these first 9 months, when this trade-off becomes clear, we see that since the sustainability ratings have a lower positive effect on flows than the star ratings, these fund managers stop pursuing better sustainability ratings. So we don't observe any longer that there is a high demand for stocks with high globe ratings. And we also observe that after the first 9 months, the effect of the globe rating on flows basically vanishes. So our conclusion is that besides this early short-term effect, when this trade-off between sustainability and performance becomes clear, asset managers have no incentive to continue to pursue at more sustainable portfolios, and even flows stop responding to the globe ratings. So let me show you the specific of the empirical tests we perform to arrive to these conclusions. So the first step is asking how the introduction of the globe ratings affect the fund's demands for stocks that are more or less sustainable. So remember, a fund, in order to improve its global rating, has to improve the average sustainability scores of its portfolio. And this is based on some sustainability ratings. So the funds that have a stronger incentive to try to improve the sustainability scores are the ones that have to improve the continuous score by a little bit in order to jump to the better category. So these are what we call here the border funds. The dependent variable in this test is how much a fund changes its the stocks, the amount of stocks that it holds in a given firm during a quarter, depending on the stock sustainability scores. So what you see here from the interaction term is that the funds that are close to the border to improve their rating increase their position in stocks that have higher ESG scores. And this is the case in the period that is immediately subsequent the introduction of the globe ratings. We don't see this to be the case any longer after 9 months. And we also observe that this effect is particularly strong for funds that within their category have relatively few peers. So why is this so? Well, this makes sense because in order to be upgraded, these funds must become better than relatively few other funds. Some other Morningstar categories are very large. In that case, the funds must become better than many peers, and this is more difficult to achieve. So these funds have weaker incentive to try to improve their effective ESG scores because the probability of getting a better globe rating is lower. So, but again, these effects emerge only in the short run, and the subsequent test will help me to show you how this is connected to the trade-off between sustainability and performance. So what I've shown you so far is the incentive of a given fund trading in a given stock during a quarter. So what we are trying to do now is to aggregate these changes in position by different funds during a quarter. And I want to show you how much is the abnormal demand of these funds in stocks with high ESG ratings that is generated by the attempt to improve the fund sustainability ratings. So this is, so my objective here is to show you that there is some evidence of demand pressure that is generated by the stock's ESG ratings. So this is what these figures aim to do. So if you look at the first one, I am using all our sample period, and what you see is that there is our measure of abnormal demand from the funds that have incentives to improve their globe ratings to attract flows. And on the x-axis, I have the stock ESG rating. So what you see is that this abnormal demand is positively correlating to the stock ESG rating, but the effect is really driven by the first 9 months after the introduction of the globe rating on the fund portfolio. There is really nothing in the long term, and this is consistent with my previous result. And I can show you this also in a multivariate setting. So since there is this demand pressure, does this affect stock returns? Basically, the question that we are interested in here is in the months following this high demand pressure, what is the performance of this stock? If this demand pressure moves the stock price, in the subsequent months, these stocks, if they become overvalued, we should observe that these stocks have poorer performance. And this is precisely what you observe here. What we are doing here is we are constructing a portfolio that goes long stocks that these globe pursuing funds are selling, and it goes short these stocks that the globe pursuing funds are buying. So what you see is that such a portfolio has a positive alpha in the first 9 months after the introduction of the GLOBE ratings, but this positive alpha disappears in the long term. That is when the GLOBE pursuing funds do not seem to care any longer about ESG ratings. So we, then we look at, so there is an alpha, and there might be some funds that might want to pursue this alpha, which would be, in our expectation, the funds with stronger incentives to do so. Well, the funds with stronger incentive to do so would be the ones that are close to the cutoff for the star rating. And this is what you observe in this table. So we look at the neighborhood of the cutoff for the improvement for the performance rating, and we consider smaller neighborhood, that is neighborhood in which the funds have ever stronger incentives. What you observe here is that the funds that have a strong incentive to improve their performance rating take the opposite position of the GLOBE pursuing funds in the period immediately after the introduction of the GLOBE rating, that is when this alpha emerges. So this leads to a trade-off between sustainability and performance. What you see here is that the funds that purchase more of these high ESG rating stocks indeed improve their GLOBE ratings. But what you observe also is that in this period, immediately after the introduction of the GLOBE ratings, they are downgraded on their performance rating. And we can show you this trade-off even without recurring to the performance rating, just looking at the effect of having a high demand for stocks with high ESG scores on the fund performance. What you see is that in the periods with the largest demand pressure, these funds have negative alpha. Now, what are the incentives? Well, here we are basically looking at the effect of sustainability ratings and performance rating on fund flows. So what you see is that the sustainability ratings matter in the period immediately after the introduction, but they have an effect that is much smaller quantitatively than that of the performance rating. The performance rating have a much larger positive effect on fund flows. Ultimately, yes.
Could you please wrap up?
Yes, I am almost there. So ultimately, fund managers care about the performance, and we argue that this is the reason why, after the initial months, we don't see any longer an effect on fund flows. In the paper, we ran some robustness tests, but what I would want to tell you before concluding is that our results are not due to the fact that the GLOBE ratings do not change and that sustainability-driven investors are happy with their initial allocation. GLOBE ratings continue to change a lot and actually change even more in the second half of our sample. What our results show is that in the mutual fund industry, most of the investors seem to be performance driven, and it doesn't look like that greater transparency gave incentives to fund managers to pursue more sustainable investment. Thank you.
Thank you so much. And now we're going to move on to the last paper for the session, which is by Margherita Giuse, was presenting it from the European Central Bank. And this paper is co-authored with Katia Vozian, Sante Carboni, and a number of other colleagues from the ECB. So please go ahead, Margherita.
Thank you very much, Gita. I hope you can hear me and see the presentation properly. So thanks a lot also to the organizer for inviting me to this very interesting session. Today I will present this paper, which is on the relationship between transition risk and credit risk. As you said, Gita, this is a joint work with some colleagues at the European Central Bank and at the Riksbank. Sante Carboni, Sujit Kapadia, Johannes Kremer, Ken Nihal, and Katia Vozian. The usual disclaimer applies, as the views expressed here are only the one of the authors and not necessarily the one of the ECB or the Eurosystem. So let me start by explaining the motivation behind this work. The transition to the low carbon economy requires firms to significantly reduce their emission. And some drivers of this transition can lead to risks to these firms related, for example, to the implementation of new government policies or technological changes, or simply a change in the market sentiment that can push firms to adapt to the low carbon economy. And if the costs are too high, or if market prices are changing rapidly, the credit risk of the firm can be affected. There can be an impact on the firm's ability to repay and service debt. And for this reason, also banks and investors that are exposed to this firm will have a higher credit risk. This transmission channel has also been already highlighted by the Basel Committee and the Banking Supervision in one of the recent reports. And there's quite some relevance in terms of policy. For example, in relation to corporate climate disclosure, in relation to how credit rating agencies assess credit risk, and also how prudential framework for banks, insurers, and other financial institutions include the risk weights or capital risk weights, include credit risk. And obviously, it has implication for central bank operations, given the exposure that central banks have to these firms. So the main research question that we analyze is how climate-related transition risk is reflected in firm credit risk. And here are some of the main results. So we have a first question: how is firm exposure to transition risk associated with firm credit risk estimates? Here we use both the credit ratings and the market implied distance to default as credit risk metrics. And we find out that there is indeed a positive relationship, especially between the emission of the firm and each of these credit risk estimates. Not only that, we find also that government policy can play an important role. Second, we see how climate disclosure moderates this relationship between transition and credit risk. Indeed, climate disclosure is found to mitigate the impact of transition on credit ratings and distances to default. And in particular, and this is the third question, also the way the firm is planning to face and to manage transition risk is related to credit risk. Indeed, disclosing a commitment to reduce emission is associated with low credit risk. Now, in terms of contribution to the literature, we have seen in recent years a number of papers already looking at this relationship between credit and transition risk. But we think our paper has at least three novelty points. The first one relates to the data set. You see that a lot of existing papers, existing research are focusing on e-scores or on backward-looking emissions that the firms disclose. Instead, in our data set, we include both backward-looking environmental performance of firms and forward-looking commitments. And also we look at the difference between what is disclosed publicly and what is inferred instead by data providers. Second, we look at two credit risk metrics at the same time using a common framework. As I said before, we use both the ratings and the distance to default. And third, we include in our sample both the US and European firms and actually analyze the potential differences with respect to the relationship between transition and credit risk. So let me start with the data set. We have in our sample all non-financial firms listed in the S&P 500 and STOXX Europe 600 in the period between 2010 and 2019. As I said, the geography include US and Europe, including the UK. And here we listed also the sources of the data that relate to both financial metrics and environmental ones. So let me start explaining also the methodology. As I said, as explained variable, we use either the credit rating of the firm or the distance to default. In both cases, the higher the credit risk estimate, the lower is the credit risk associated with the firm. And we regress it using a panel regression on the exposure of the firm to transition risk, namely the firm level emission variables, both in terms of intensities, so as a share of firm's revenues, and in terms of level. On top of that, we also include in the regression how the firm is managing the transition risk. So if the firm has an emission reduction target, forward-looking target. And then, of course, we include also financial variables that can affect credit risk and macroeconomic variables. So let's look at transition risk exposure of firms. On the left chart, we plot the share of firms in our sample that do disclose somehow emission-related variables. And we split here companies that we classify as low, medium, and high emitters according to the distribution of emissions in our sample. What we see here are three things. First of all, the positive trend in disclosing that concerns not only firms that are in the low and medium group, but also the high emitters, actually, especially the high emitters, probably because they are the ones more exposed to scrutiny, for example, from financial markets. And third, we see that most of this disclosure is actually audited, so it's verified by a third party. A similar trend is found also if we look at the share of firms that disclose an emission reduction target. Also here you see that the trend is positive. High emitters tend to disclose more targets, and actually the vast majority of these disclosures are actually audited. Now let's start with the first results. As I said at the beginning, we are interested in assessing the relationship between transition risk metrics and credit risk metrics. We start with credit rating. We're interested in the coefficients here, beta 1, beta 2, and beta 3, that indicates the relationship between scope 1, 2, and 3 intensities and levels of the firm and their credit rating. And what we find is that scope 1 and 3 intensities are indeed associated with lower credit rating in a negative way. So higher intensities are associated with lower ratings, so higher credit risk. Similarly, we find that even in levels, scope 1 level are also significant. We can discuss also about the different metrics later on if you're interested. Similar result is also found for the distance to default metric. Again, here we are interested in the coefficients beta 1, beta 2, and beta 3, which are listed here, both in terms of emission intensity and emission level. And also here we find that higher intensities are associated with lower distance to default, so they lead to higher credit risk. This time, instead, the levels of emissions result to be insignificant. Now, let's go to the second and third question. How does the disclosure of backward-looking and forward-looking variables affect the firm credit rating? To the regression that I showed earlier, we add a dummy variable, which is equal to 1 for firms that do disclose their emissions. And we add also the dummy variable related to the commitment. So it's equal to 1 when the firm discloses a forward-looking commitment, an emission reduction target. What we find here is very interesting. First of all, the act of disclosing emissions, both for intensities and levels, is associated with better ratings. So there is a positive effect. And instead, a reduction in disclosed emission intensity is associated also with better ratings, which suggest that the rating agencies do monitor the evolution of emission intensities over time. So they monitor the path of the firm. Third, we find that also the dummy related to the commitment to the forward-looking emission reduction target is significant and positive, which means it's associated with better ratings. And here we show only the dummy for the disclosure of a commitment, which is a qualitative variable. But in the paper, we include also the similar regression, in which instead we have quantitative variables related to the commitment of the firm, which are the number of years that the firm has committed to reduce emissions and the targeted emission reduction as a share of actual current emissions. And we find that the more ambitious is the target, the better is the rating. So there is a very positive signal for credit rating agencies. Now we look at the significance of these variables as estimated in a logit regression. Here, instead, we want to visualize these results and we plot the estimated impact of some of the variables on the percentage of credit rating notch affected. So the blue bars indicate the estimated impact of a one standard deviation change in environmental metrics, and namely the scope 1 and 2 intensities and the change in scope 1 and 2 intensities disclosed by the firm. And what we find is that firms with higher disclosed intensities and an actual increase in emissions tend to have worse ratings. By contrast, when we look at the estimated impact of the disclosure dummies, both in terms of backward-looking metrics and forward-looking targets, we find that firms that do disclose this information tend to have better ratings. Now we see that, for example, for the disclosure of backward-looking emissions, we see that the effects on average almost outweigh, right? So if a firm discloses a high emission intensity, it looks like the effect on the rating is almost zero. At the same time, this is an effect on average. So for high emitters, actually, the impact of the disclosed intensity is much higher than the one of the disclosure dummy. And as a comparison, we also add this red bar that shows the estimated impact of a one standard deviation change in leverage, which is one of the main variables affecting the rating, which is comparable to the one that scope 1 and 2 intensities have on the ratings. Now we go back to the distance to default and we ask again, what is the impact of disclosing emissions and what is the impact of disclosing a forward-looking commitment? And similarly, as observed for the ratings, we find that both for emission intensities and emission levels, disclosing this information increases the distance to default, which means that it lowers credit risk assessed by the market. Also, committing to lower emission increases the distance to default, so it has a positive effect on the risk metric. And again, here, in the interest of time, we won't present the results, but we find that with quantitative target information, the more ambitious is the target, the larger is this effect on distance to default. Now, what our sample allows us to do is also to look at different types of firms. And in particular, we are interested in investigating whether credit rating agencies assess European firms differently from US firms, given that these two jurisdictions have quite different environmental policies, as they did in the last years. And therefore, we include here, we have a triple definitive model. The first dummy that we include in the regression is the treatment, which identifies firms that are either in the top polluting industries or in the top quartile of most polluting firms based on Scope 1 intensities or based on Scope 1 levels. So these are firms that can be considered high emitters by credit rating agencies. Now we want to exploit.
Margarita, we should start wrapping up.
Yeah, I'll do so. So we exploit the Paris Agreement as a shock, which is exogenous to the decision of the firm. And we include a dummy of transition policy equal to 1 for firms domiciled in European countries. And we find that after the Paris Agreement, the ratings of the most polluting firms in Europe got worse relative to their US peers. As we said here, actually, the impact is quite large on credit ratings. This is almost one rating notch, and this is approximately half of a credit notch, which suggests that the relationship between transition and credit risk depends also on the credibility of the commitments of the country where the firms operate. So as a conclusion, what is our assessment of this relationship between transition and credit risk? We show that high emissions are associated to some extent with higher credit risk, both in terms of ratings and distance to default. So somehow the transition risk is already priced or included in these metrics. Second, we find that the policies related to low carbon transition of governments do affect this relationship. And third, we find 2 interesting results related to disclosure, so that disclosing emissions can mitigate the impact of transition risk on credit risk. And more importantly, disclosing an emission reduction target mitigates this impact. Of course, we need to work a lot on the data. There are different caveats here related to the availability and reliability of the metrics that we use to proxy transition risk. But still, we think that our results have important policy implications. First, for credit rating agencies and how they incorporate ESG and climate factors in their credit risk models. Second, they have implications for the prudential regulation of financial institutions, the link to capital risk weights, for example, for banks and insurers that do use credit ratings in their assessment. Third, there are implications for central banks' monetary and non-monetary portfolio operations. And fourth, as we said, there are implications in favor of an enhanced corporate climate disclosure, not only of backward-looking data, but especially of forward-looking ones. So I will stop here. Thank you very much for your attention, and I look forward to the discussion.
Thank you. I'd like to turn now to our discussant, Marcin Kacperczyk from Imperial College London. And, Marcin, please take it away.
Okay, thank you very much, Gita, for running the show, doing it so smoothly. And I also wanted to thank Debbie for giving me the opportunity for one of the more challenging tasks I have ever been equipped with as an academic. So at first, when I heard from Debbie that I'm supposed to discuss 3 papers in one go, it felt a little bit scary, but then I thought everything is scary these days. So how about I take that challenge to kind of comply with what we are facing in a daily kind of life. So what I decided to kind of present is a little bit of a subjective view of what I think are the key questions and how I think these papers that were so nicely presented fit into this particular agenda. So this is a conference on sustainability, and I don't think I need to motivate it too much, but what I think is important to recognize is that there is quite a visible shift in the way how the society is perceiving what's happening in this particular space. And I think this shift is largely dictated by physical changes that we are observing. I mean, it started with some kind of malfunctioning of a governance system, maybe the lack of inclusivity in corporations. Now I think this is more related on the climate kind of centered issues. But I think it's fair to say that we are observing some major responses both on the investment side and on the corporate side to this particular social changes. And what I want to say is that from my personal perspective, the ESG term that is oftentimes attributed to this particular effects integrates environmental, social, and governance principles But I personally feel that at least recently, the focus has been mostly on environmental aspects, and maybe for good reasons, because I think the economic challenge that we are facing with those seems to be the largest one. And I think the answers that we are able to provide at the moment are probably the least among the three. So some of the discussion that I'm going to provide now is going to be kind of put in the context of this environmental objectives, but of course, hopefully some of this is going to also kind of continue into the other two objectives. So what is it that we are observing is basically there is a mix of actions by public and private sector. We have the climate conference, we have commitments, we have disclosures. And I think what's interesting about these actions is that they kind of have a largely common objective function, which is we are seeing this link between the changing in the climate as being related to the emissions levels in the corporate sector. And that's provided actually by the scientists. In fact, this year's Nobel Prize in Physics was largely about this particular evidence. And I think that's kind of nice because we can tie some of the policies and movements that we are observing to exactly to some of these so-called carbon net neutrality targets. So what is it that's kind of interesting in this movement? So what I think it's interesting is what is it that we need to do to actually achieve the goal, which is to control our emissions or basically reduce some kind of negative effects on the society. So kind of chronologically, if you think about this problem is not new. We've heard about climate change for at least some time, but I think what's new is how we are thinking about approaching it. So my personal kind of reading of what has been happening over the last couple of decades is that for a long time period, it seemed like the society has delegated the problem to the public sector. There was a kind of a strong belief, largely motivated by theoretical evidence, that governments or the public sector should be able to solve the problem by thinking about some kind of carbon pricing or a mix of some kind of trading permits, etc. So, but what's interesting about that is that despite the fact that this idea is very appealing from the theoretical point of view, there is not too much actually happening in practice. We did not observe any major policy that would shift this particular problem forward. And I think one of the reasons why this is not happening is that coordination costs oftentimes are too high. So instead, what has happened more recently is that we have turned into a private sector, and in particular the financial sector, as a potential alternative to at least provide some discipline in this particular problem. And I think it's quite interesting because I personally view that the mix between the public and the private kind of sector engagement is the right way to think about this problem, because none of the individual actions is actually going to solve the problem in general. So how is it that this financial sector can potentially matter? We talk about this a little bit today. We are talking about the impact through market, like affecting market prices, divestment activities, etc. But we also can talk about some kind of direct interventions, governance effects, etc. So Luigi Zingales and co-authors have this very nice paper that talks about the distinction between making impact through one versus the other activity. What's important in general to recognize in this particular discussion is that if we actually want to make a change, this change is not gonna happen without costs. And I think this whole idea of doing well by doing good is, I think, a little bit of a fallacy. And we need to understand that there is a little bit of a trade-off between what it is that we are trying to achieve on the kind of social objective vis-a-vis what it is that it may cost us in terms of economic costs. And I think this is a concept of transition risk that many people today have talked about, that is faced both by the corporate sector and investors. And there is already some evidence in the literature, at least on climate finance, that suggests that there is some actually pricing of this transition risk, at least in some markets. So I have worked with Patrick Bolton on this question in the context of equity markets, and we have seen quite significant effects in terms of cost of equity differences between firms with high versus low measures of transition risk. And then you can also see actually in other contexts like banking sector, have a recent paper with Jose Luis Pedro, which shows that banks that take a green designation are actually quite active in rationing credit to the corporate sectors which is brown. So there are key questions then related to this whole process, which I think kind of summarize what the three papers I'm supposed to discuss are aiming to achieve. So the first question is kind of basic, which is, it's not obvious at all that the fact that we care about sustainability, we hear, is the predominant paradigm among individuals. So in some sense, we would like to understand to what extent the issue of ESG is an issue of a handful of participants, or is it something that is actually broadly reflected in terms of different kind of market measures? And then the question is, if we do care about these aspects, what is the kind of trade-off that you face between being green potentially and sacrificing some of this traditional financial value? So that's the first question that I think is interesting to think about. The second one, from the perspective of corporate sector, of course, is how large these transition costs are. To what extent what we are seeing as a pressure from financial markets is actually a significant margin to actually matter. And I think that's where the third question becomes interesting, which is, do these forces that we observe from the private sector actually lead to meaningful differences in terms of real outcomes? And here, real outcome really means a reduction in emissions or some kind of improvement in environmental scores. So what is it that these papers have to contribute to these three questions? So I kind of ordered the papers in a different order than Debbie sequenced them, and I apologize for that, but I hope it is gonna become clear. So the paper by Maria Assunta Gianetti and co-authors, to me, is the paper which really contributes to the first question, which is, to what extent investors care about ESG, and what is potentially this preference for ESG in terms of intensive margin kind of adjustments. And the main result of the paper is that, by and large, the investors in mutual funds that are in the US do not seem to consider the social objectives to be as important as, for example, the return motive. And I want to say that this kind of result is not necessarily a one-way kind of result. We have some evidence in the literature that goes in both directions. So, for example, there's an interesting paper by Nick Bolen in 2007 that has argued that fund flows to mutual funds with ESG designations are fairly sticky. So it seems like actually investors are more loyal if these mutual funds are actually following some principle. I have also worked with Harrison Hong on the work which argued that investors are actually actively divesting of what we call sin stocks. And in fact, those who abstain from investing in this kind of assets are potentially paying the price of about 2 to 3% per year annual difference in returns. And then there is a recent work by Luboš Pastor and co-authors, which shows nicely that there is a strict preference for some kind of green stocks. At the same time, there is some evidence that not everyone actually exhibits this preference in terms of the portfolio behaviors. For example, when you look at carbon-related portfolios and divestment based on the level of emissions, we really don't find much of evidence that institutional investors are screening on these particular margins. So what is it that this paper is kind of doing? This paper is taking this change in the Morningstar ESG designation as a shock to managers' preference for ESG type stocks. And it kind of argues that in the process of actually improving the ESG rating, the funds themselves may actually suffer in terms of their performance. And then the kind of main idea is to what extent this trade-off between improvement in kind of ESG rating is actually enough to make investors shift in that direction rather than stay with the better performing funds which don't actually make this particular change. And then the result is that it seems like that investors are actually moving to high ESG portfolios, but this effect is very short lasting of about 9 months. In the subsequent 9 months, this result seems to be actually significantly weaker. So the second question is conditional on the fact that some investors actually care about this transition risk, or they care about this ESG kind of transition. The question is, how large are these transition costs? And the paper by Carbone et al. Is the paper that talks about this question from the perspective of credit markets. And it was actually very nicely presented that the literature on this question is kind of already out there, but it's largely concentrated in terms of ESG metrics and maybe bond prices. So the improvement here is to look at other measures of transition risk and potentially look at other markets as well. And the paper finds some interesting finding, which is that companies with better commitments to future emission reduction, more information disclosure on emissions, and generally speaking, lower emissions are facing greater distance to default and better credit ratings. And there seems to be some amplification of this effect following the Paris Agreement of 2015. And finally, the last paper by Lakshmi Narayanan and co-authors is the paper about the real change. To what extent actually that we observe some kind of effect on the real side of the economy, which is really what we as a society care the most about. And what the paper shows is actually some nice evidence that there is actually adjustment of environmental quality in the context of activism by some shareholders of companies. And companies adjust by actually investing more in green initiatives and actually doing some emission abatements. So what I think is interesting about this paper is that we actually don't have too much evidence on the real side of this particular problem. I think most of what we have been focusing in terms of the climate finance kind of discussion was on the tools that kind of create potential disciplinary forces. But we kind of have less evidence on whether these tools actually lead to the real change. So I welcome this paper as a nice contribution in this particular direction, even though I want to argue that there is some literature that is related to disclosure of emissions, in accounting especially, which argues that actually following the disclosure initiatives, companies do reduce actually their emissions afterwards. So there is this link to a real sector as well. But nevertheless, what the paper finds that there is actually the positive link between activism and performance. And it has actually broader kind of spillovers to the larger economy, not only to the companies that are targeted by the particular activists. So let me now offer a couple of comments on each of these papers. This is going to be more of a standard kind of list of ideas, but I hope these are going to be also common to the general theme of this discussion. So when it comes to the question about the ESG and whether we care about it or not, I think the one question that immediately comes to my mind is what is the underlying economic mechanism that drives that? So Maria Sunta and co-authors seem to be pushing the idea of a price pressure, which is the idea of some kind of mispricing that creates the temporary differences in terms of the performance of greens versus brown stocks. But I could think of an alternative story, which is the more traditional one, and it's a divestment type of mechanism. So that would be an interesting question to resolve, or at least discuss. To what extent is this motivated by some kind of trading activity vis-a-vis some kind of more systematic divestment? And I think what's interesting about this question is that it links to some of the ideas that Jonathan Parker was discussing in the previous session, which is this notion of how much of what we are observing in the markets is really an equilibrium versus kind of transition from one equilibrium to another equilibrium. So what I found problematic by kind of casually observing the discussion of these issues, even among the policymakers and media, is that oftentimes we take results which are really the off equilibrium results and we try to interpret them as the new kind of equilibrium. And I think we need to be a little bit careful about it. And in particular, in this paper that Maria Sunta looks at, we are looking at a very short time period. So in this regard, it's not really obvious that what we are observing within 1 9-month period is a steady kind of new equilibrium with a new kind of investor pricing, etc. So I would like to understand a little bit more what this means. And as a small point, it's related to Morningstar kind of usage in the paper. We need to understand how Morningstar stars are actually assigned. They are based on the average of 3, 5, and 10-year performance of the past fund returns. So clearly, it seems to me that there is a misfit between what it is that we are expecting to see in terms of results and what it is that the stars are actually capturing. So I'm quite surprised that we would see any effect on stars if the stars actually have nothing to do with or very little to do with the performance of these funds that goes into the creation of the stars. So some discussion of that sort, I think, would be very useful. And then, of course, the question that comes to mind is the absence of sensitivity of fund flows that the paper shows to the globes evidence that investors don't care about ESG. So I wouldn't go that quickly into that conclusion, because what could simply this mean is that the fund flows which are sticky in the context of ESG get adjusted in the short-term period. And after that, investors are kind of comfortable with where they are with their allocations. So in this regard, the fact that they are actually not reacting much is consistent with the evidence that ESG flows are actually fairly persistent. And then the related question, and a little bit challenging empirically, is the question of selection effects of investors. So we are kind of making a comparison between before and after kind of flows of mutual fund investors, without realizing the fact that actually the investor base could be changing relative to the change in the policy. So what I would expect to see in the data is that investors who care more about ESG are going to be the new investors who actually invest in some of these funds. And it's not obvious that the same investors are the ones who invested before. So ideally, what we would like to see empirically is some kind of investor fixed effect to argue for this. But anything in between that the paper could do to actually at least speak a little bit about this selection, I think would be very useful. So then the question that I think is probably the most interesting and important question economically in this paper is the question about this trade-off between the performance and the ESG designation. What's the kind of price that the investors are willing to pay by actually getting a little bit greener? And clearly, it's not to say that investors don't care about this, because in the short run, they do actually react to the improved ESG performance. So they do care about it. The question is how much they care about it. And the way how the paper tries to kind of look at this trade-off is a little bit indirect, because what we are looking at is the relationship between the globes and the stars with the performance. But we are not actually looking at the direct effect of each of these two jointly on the flows. And from the perspective, what it is that mutual fund companies care the most about, it's actually the flows. So I would like to see a little bit more discussion. Is the flow coming actually out of the funds which are the good ESG funds, and it's going towards the funds which are actually good performers but bad ESG type of funds? So this would be a more direct way for me to test this particular mechanism. So let me skip, in the interest of time, the last point, but let me now move to the second paper. The second paper is about measuring the transition costs in the context of credit markets. And I have a couple of questions here which are kind of interesting, I hope. So the first question that I have about the paper is that it takes this narrative of thinking of credit markets as just simply another market to look for evidence of transition risk. And I found this kind of narrative a little bit problematic, because if I think about credit markets, I think mostly about credit markets as the market that prices default. And it's not obvious that every instance of transition risk is automatically kind of synonymous with the idea of default. So what I think I would like to see more in this paper is some kind of conditionality on how much actually this transition risk is about pricing the default risk versus non-default risk. And if the story is that this is about the default, it's about credit markets, I should expect to see that actually the results are going to be stronger in the kind of states of the world where the companies are actually closer to default, and not really as important in the context of companies which are really far from default boundary. So the second question, which I think is a nice equilibrium kind of question, is the question about substitutability. So in some sense, if you want to take a big picture kind of conclusion of what this paper does, the question is, can credit rating agencies kind of put a pressure on the corporate sector by means of actually reducing their credit, or maybe kind of penalizing it in a different way in the bond market? But then, of course, this idea is only going to work to the extent that the company is going to be financially constrained to some extent. So what if the company can actually substitute to something else? Then it becomes really like a moot point. We are observing some kind of pricing of these events in the credit market, but companies may go to markets which actually don't seem to attribute the same kind of value to this particular problem. So I think it would be interesting to at least think a little bit about it conceptually, and whether you can maybe look at another kind of conditioning information that is related to this kind of financing constraints idea. And then finally, what I think is interesting in this context of credit markets is that credit markets to some extent are pricing two types of climate risk story. One is the story of adaptation, which is the story of the transition risk. That is what the paper is talking about. But of course, we are also talking about the story of mitigation, and it's related to the damages that potentially could be related to the physical aspects of the climate change. And I think what we are seeing in the data in some sense is the combination of the two. And I think what would be interesting to see, at least from my perspective, is some kind of attempt to separate one versus the other one in the data that you have. So finally, let me move on to the last question, which is the pressure sufficient to trigger the change? That's the paper by Lakshmi. And I think that's a very relevant question in this context, because ultimately this is what determines our welfare in this problem. We care really about these emissions to go down because we worry about the climate change. So there are a couple of questions that I think I would like to see a little bit more addressed in this paper. So the paper is using this nice shock on the activism kind of initiative, but what I think is missing is really a careful documentation of what this activism really means. Lakshmi talked anecdotally about this as changing the board composition or anything of that sort, but there is no result really that proves that. And in particular, I would like to see what is the kind of penalty for misbehavior in this data? How is it that these activists are actually going to penalize a company in the context of kind of off-equilibrium movements? Is there a way in which you could actually put some estimates on how large these penalties are so that we can understand what's the trade-off that the company faces when actually is facing the threat of the activist action in this particular context? Then the second question is, to what extent the story that you are identifying is the story of activism vis-a-vis something like a salience of the activism itself? So you could think that basically they almost look the same, but clearly they are not the same, because in the context of activism, you can think about just changing the cash flow process through the way in which the activists act. But in the context of salience, you could think about some kind of coordination around the activists that actually could also lead to some kind of market price adjustments, and that's in the spirit of the divestment activity. So again, this is leading nicely to this trade-off that Luigi and co-authors was talking about in the context of exit versus voice. And then finally, the question about the spillover effects is something that I considered quite interesting. And I think the kind of main two questions that I would like to ask the authors on this paper, on these questions are, what's the source of the spillover effects? Is it about changing social norms? Maybe there is a peer pressure that comes from the firms that I already targeted, or is it about some kind of market structure change in terms of competitive forces, etc.? So to the extent that production of one firm is changing in response to this activism, we could observe other companies to kind of respond just to that particular feature, even if they don't care about the social norms to begin with. So, and kind of maybe of a challenging question is there a way to provide some kind of estimates of how large these effects are from the kind of a big picture economic perspective, not just individual kind of firms perspective? So let me conclude by kind of summarizing what I've seen in these papers. I think clearly sustainability is a primary concern of the modern society. I think what we are kind of seeing is an increasing pressure of both the public and the private sector to actually make the change. And I think these papers are kind of responding to this question, to what extent financial markets internalize this changing paradigm. And they offer some mixed results in this regard. Credit markets reduce risk for firms that are actually progressing more in the transition. Activist investors seem to drive the reduction in pollution. At the same time, there could be a little bit of a non-robustness that comes from the fact that some investors may simply value monetary objectives more over this kind of ESG objectives. So to conclude, I wanted to raise a couple of questions for the future, something that has not been studied in these papers, but I consider quite important to take forward. So one of the interesting questions is to what extent actually we are in some kind of vicious cycle in which if we penalize companies in terms of actually rationing their capital, they're actually not able to invest in the environmental performance. So how is it that you go out of this trap? And I think there has to be some kind of credibility in the way how companies are going to communicate to the capital providers that what they are actually planning is something serious. So I think this is kind of in the spirit of this greenwashing versus real adjustment in terms of reducing your emissions. Then the second question, which I consider quite interesting, is the fact that we have observed quite a bit of movement on the disciplinary forces. But I think it's fair to say that we did not see much of the adjustment of the real sector in terms of reducing emissions. And I think one of the interesting questions is, why is it the case? And I think maybe what's happening is that market pressure is not sufficiently large. So I think of this analogy to the supermarket visit. So far, if you go to the supermarket, you try to get a plastic bag, they charge you, say, 10 cents for using that, which is quite cheap. And I think that many people don't simply care about bringing a non-plastic bag just because that cost of that they have to pay for non-compliance is very low. But what if that plastic bag was $100 instead of 10 cents? Clearly, we would observe everyone or most of the people walking in with their non-plastic bags to the supermarket. So maybe that's what we need. We are not seeing enough of the pressure to actually drive the change. The question
Martin,
that I think, yeah.
Martin, I'm sorry, could we wrap up so that there's time for some questions?
So let me just conclude that I think what I really want to understand as the last question is, what's that interaction between the public and the private sector, and how is it that it can come to some kind of optimal policy that is going to drive the change? Thank you so much, and I apologize if I overrun my time.
Not at all. Thank you so much, Martin, for your very thoughtful observations on all three papers. We'd like to open it up for questions now. We already have a few of them, and let me start off, Martin, just to tie into what some of your remarks. I think when we, in your last slide, you talked about, starving companies for capital, right? With the oil collapse that happened in 2014, 2015, what we have seen, a lot of fossil fuel companies are, as you said, starved for capital. So when we take a step back and we see companies under pressure trying to reduce their emissions, and private equity between 2010 and 2020 has invested about $1 trillion in fossil fuels. Specifically here in the US, coal-fired power plants are one thing that they're buying. So both from a regulatory perspective and an activist perspective, it's not just important that a company either divest itself or whatever it does, but who is that asset going to, right? That's a very important question. And particularly when you relate it to credit risk, it's actually a passing on of the credit risk. And perhaps systemically, we may end up with greater risk if whoever it's passed on to, that agent is not either required or has no incentive to disclose, and also does not have an incentive to improve, environmentally. And I would love to hear what the audience has to say on that. I'd really like to hear or what your thoughts are.
I don't want to crowd out, so I'm happy to offer my thoughts, but maybe someone else would like to chip in first.
Yeah, so I also want, there is a question from the audience for Margarita about the emissions data in their paper, which is, was there sufficient emissions data for a robust statistical model, given that they are self-reported and they're not frequent, they're annual or quarterly, and we have a short time history, right? So how did you I think the question is, how did you manage to get enough data, and how can we be sure that the regressions capture that effect and not some kind of omitted factor?
Yeah, so on the data, this was one of the most difficult parts, as all the people working on this topic know. And we actually have in our sample over 500 companies, and we observe them over 10 years. And we get yearly environmental performance data from a commercial data provider called Urgentem, which is quite specialized. But since these are also listed large firms, and as I shown in one of the slides, they increased a lot the information they disclose around their climate environmental performance. So there was not such a problem. It's true that we have also yearly observations, but again, the number of firms and the number of years were large enough. In terms of omitted variables, I mean, there can always be something, right, that could drive a bit of the error in the estimates. But in the paper, you will see that we run a lot of different model specifications and also a lot of robustness checks to check for potential sources of endogeneity, for example, coming from the governance of the firm or other factors that may influence the relationship between these metrics and credit risk. But it's definitely a good point, especially on the data.
Yeah. What do you think about what Martin had to say about the physical risk in addition to the transition risk?
I
right?
think
Mitigation.
that would be a wonderful addition. So we focus exactly for the data reason on the transition risk, because for physical risk, it's much more difficult at the moment. Even I would say actually, especially for these large firms to assess really their exposure, because they don't have only the headquarter for which we normally do have location data, but they also have a lot of subsidiaries. And therefore to assessing how they are exposed to physical risk is not easy. Also, we normally look at scores talking about physical risks. We look at, probabilities that certain events occurred in a given location. At the same time, it can be that the firm is insured against some of these hazards, and we don't have this information, at least not at granular level for sure. So it becomes very, very complicated, both for the type of firms and for the data that are typically available to include it.
I mean, if I may add something on that, which I think Geeta is already hinting. In a context of credit, I think it's quite important to think about this physical risk, because if you think about these tail events which ultimately matter for the credit markets, this is actually where the physical risk becomes a real issue. I think in the context of equity, I think we kind of have a strong view that transition risk really is what matters mostly. But I think here you need to be a little bit more careful. And I kind of suspect that what your measures are actually capturing is the combination of the two. That's why I suggested that you try to actually separate to the best possible kind of ability. And I think one way to give you kind of a inspiration is to think about cross-industry variation, because I think different industries are going to have different exposure to one versus the other. So maybe looking at the data from that angle and trying to actually see whether there are some kind of differential pricing effects in one versus the other would be a promising avenue to actually make progress.
But I have a question related to this. Why do you think, for example, so we proxy transition risk with emission related variables. Mm-hmm. Why do you think emission variables include some information related to physical risk?
Well, think about the exposure to the physical risk. If I have oil majors, which are basically in the situation where they have high emissions, that's just like a variable that is correlated with their exposure to the physical risks. In this regard, I think that's one way in which I can think about it. So it's just like an omitted, or it's like a proxy basically for some of this. I'm not saying it's a perfect proxy, but I think it's very hard to argue that it's orthogonal to this physical risk considerations.
I think if we were to go beyond scope 1, we might be able to capture it, but that's very hard to do. Because you can compare a Facebook to an Exxon, the emissions are so much lower at the scope 1 level, but then when you go further down, it increases, right? So, yeah. I actually have a question for Lakshmi about your paper. I was very curious because from the slides that you showed, your target firms were larger. They underperformed in terms of returns, but they had higher profitability. And I was wondering if you had any intuition about why the return underperformance, and whether in your conversations with the BAP, anything came up about that targeting firms that have underperformed their industry peers I do know hedge funds use that all the time when they mount activist campaigns, and also how is it correlated to the collapse of oil prices, because you had a lot of these in 2015.
Yeah, thank you so much, Geeta, and thank you, Martin, for your wonderful thoughts. So when we spoke with the pension fund system, they effectively told us that the way they decided or judged on how to choose a target firm was based on how these firms could, potentially create, environmental externality, and they used this list called Carbon Underground 200, or now it's called the Fossil Free Index. And they effectively looked at, how much of carbon dioxide, these firms can emit in sense. And we asked them specifically, did you kind of choose anything else, or, were you thinking about how it's going to impact your returns, or how it's going to impact this? They were very categorical in mentioning that was not in their consideration. The only thing that they wanted to emphasize was, these firms they felt were not adequately addressing climate change risk. And we spent quite a lot of time in the paper, and we're updating it now in kind of looking at other variables which we can observe. And what we find is only firm size that marginally picks up, and this being on the list of the fossil-free index. These are the only two things that pick up in general. And one can, as Marcin was alluding to before, one can imagine that larger firms will also have the larger potential to create these externalities. But to kind of emphasize again, we think it's important because even though these firms are large, they also contribute quite significantly to the climate change risk. And hence, if one thinks about marginal returns to activism, then one might think that getting these firms to improve along the dimension might be a lot more impactful than getting those smaller firms which are not doing anything to begin with and asking them to make a change. So the scale of the issue, we think at least in this context, there's something positive to take out, that having these activism campaigns on these larger firms might be a lot more beneficial in terms of the marginal value. But of course, we don't have a quantification, and as Marcin said, maybe that's something that might be useful to have in the paper. So that's kind of where we were.
Well, it's kind of interesting because it's a way to ward off getting somebody on the board of directors, right? You take these kind of measures to prevent them proposing somebody for at the AGM, and because that would be an even bigger headache for them.
Right, absolutely. And when we spoke with them, they in fact were mentioned that we felt that we were not being heard, even though we had specific concerns. And this was their way of communicating that hey, if you don't make a change, then we are going to be there together with the other coalition members, and we're going to make sure that if you don't do it, then we have our representative to get things done. And perhaps that's the way things will evolve in the future, that governance changes would kind of be required, and this threat that's looming on these firms might be the ones that pushes them to make these changes.
I just wanted to echo on one
example of that.
Sorry,
I mean, Exxon is an example of that, where for years they did kind of they wouldn't even provide a report. And then you had in 2017, when BlackRock and Vanguard voted their shares, it tipped the balance, right? I'm sorry, Marcin, you were saying?
No, I'm sorry. I thought you finished. What I wanted to say, I wanted to echo on your comment and kind of link to one of my comments. Think of the recent activity with Exxon, Royal Dutch Shell, and all this basically governance kind of push. So what I want to say is that this activism is potent, but I think really the kind of focal aspects of them is what really matters. Because I don't think that Exxon would be really scared of someone to tell them you need to do X or Y, because people have been doing that for a long time and they have always dodged the problem. The reason why they actually responded this time is that this has become actually a big issue. Everyone was talking about it. And I think from the perspective of the company, of course, this is not a desired outcome. So I really think this is an interesting kind of way it's a kind of linking to your point about large firms versus small firms. The large firm, when it's approached by this activist, is gonna face different types of pressures when the small firm is facing that, because they become kind of in the center of attention. The small firm is not gonna become in the center of attention.
I also had one last question, and Marcin, please, this is very informal, so please do chime in. I had a last question for Maria Jacinta about your paper. It appeared like the sample had fairly young funds. I'm sorry, I didn't get a chance to actually calculate out what the AUM was on average or the median. I know you had logs. I just, they had to be at least 2 years old, but I was wondering if you can give us a sense. And was this all categories of US equities?
Yeah. So I think, so these are basically all categories of US equity funds. They have to be at least 2 years old to be rated, but otherwise is standard sample of established US mutual funds. And I want to stress that these are not funds with ESG designation. Okay, so mutual funds with ESG designation that are actually a very small minorities. These are standard funds with all possible categories that we find in Morningstar, and their portfolio can be ranked on the basis of their sustainability. So I think that the reason why the question is interesting is that we look at a corner of the asset management industry in which investors typically invest on the basis of performance. And then the way in which I interpreted my result is mostly on the incentive on the fund managers that are, of course, attentive at small changes on the performance, the star rating, the globe ratings, okay? The effects on investors might be due to inattention, but what is important is that even if there is a fraction of investors that have that care about sustainability, they are not attentive enough to give the incentive to the mutual fund managers, okay? Of course, there might be other investors in the markets that affect price and give some incentive for improvement above and beyond the engagement, but is not according to my paper, is not a mutual fund, and is not a mutual fund because of the sustainability ratings.
So can I pose an alternative? And this is not
of
well
course.
thought out at all. So, forgive me if it doesn't make sense. This was a period when growth really, really outperformed value, correct? So, growth stocks. And so, and particularly tech, all of those, that whole space. It was also a period when active management has lost assets, in part because of the push for lower fees, lower expenses, and the fees are pretty high in your sample. I saw it's 100 basis points or something like that on average. So if this is a very heterogeneous sample that has value funds, growth funds, a couple of things. One is by prospectus, you're not going to pursue sustainability if you're a value fund. It's very hard. I mean, you're not going to find stocks that rank high on sustainability, right? Because of the universe that you're kind of looking in. But the second thing is there was a general push among fund managers, given that they were underperforming the index, and the index was so hard to beat, there was a general push towards these large index stocks that were growth stocks. And how do we separate that out from your?
I think that is, so remember the globe ratings are relative within other funds in the category. So there may actually be a value fund that has an absolute sustainability score that is worse than a growth fund, but has a top globe rating. Okay, and that is what the fund manager was pursuing at the beginning, because it had observed that upon the introduction of these ratings, this was attracting flows. But in the long term, when you see a bit more data, you see that, well, there is a trade-off, and the way we interpret the data is that when this trade-off becomes clear to the fund manager, they just concentrate on performance. So, but all these, so besides, so the ratings are all relative to the funds of the same category, but this is done also when one looks at exposure to different factors. So that, of course, differs across funds and capture these systematic risk exposures.
I don't know, Martin, if you had any thoughts.
No, I agree with your comment on the growth versus value. I don't think it is just a problem of this paper, but generally speaking, I think kind of separating these effects from each other is quite difficult. And maybe just to add to something I didn't talk about, but potentially interesting, is also the specific period that you, Maria Sunta, study, which is 2016 was right after Paris Agreement. And 2017 was kind of a consequence of the new president of the United States being elected. So in some sense, you are going to have a little bit of a confounding effect coming from both of these events.
Yeah, so actually, this Trump period was something that we were concerned was driving the underperformance of the stock with high ESG ratings, because of course those are also might have stock with high carbon emissions that would benefit from the Trump administration. So likely the sample is such that we decided to split the sample in 9 months and 9 months, but we can repeat the first period of the analysis to the first 6 months, and actually adding the period the last quarter with the Trump election makes our results a bit weaker. So these first 6 months without the Trump election actually lead to stronger results in our contest. So there is this higher demand for stocks that have high ESG ratings that creates a temporary pressure. Of course, this could be an effect of what you call divestment or investment in ESG stocks. Okay, so but this in our interpretation, this affects the incentives in the second part of the sample in a way that these fund managers don't seem to react more to sustainability scores.
Thank you, Maria Santa. Thank you, Marcin. Thank you, Margarita and Lakshmi. This is a great session. Debbie, over to you. Sorry, we ran
thank
over.
you.
Sorry.
We ran over a bit, but I figured that since we're not renting any conference room, there's less cost. But thank you to everyone in the session and all the participants all day. It was a very good first day. Hope to see you back tomorrow and have a good rest of the day. Thanks again so much. Take care. Bye.
Thank you,
Thank you so
everyone.
much.
Bye. Thank you.
Thank you.
Bye.
Bye-bye.
Bye. Bye. Bye.